Welcome to this educational video on equity markets. In this video, we'll cover everything you need to know about equity markets, from what they are to how you can invest in them. Let's get started. What are equity markets and how do they work? Equity markets are where stocks are traded. Stocks represent ownership in a company and are bought and sold by investors on stock exchanges. When a company goes public, it issues stocks that are sold to investors, who can then buy and sell those stocks on the open market. Prices for stocks are determined by supply and demand, and are influenced by a variety of factors, including company performance, economic conditions, and investor sentiment. Understanding the role of stocks in equity markets. Stocks are the most common type of investment in equity markets. When you buy a stock, you're essentially buying a small piece of ownership in the company. As the company grows and profits increase, the value of your stock can increase as well. However, there are risks associated with investing in stocks, as their value can also decrease if the company performs poorly or economic conditions worsen. How to analyze a company's financials to evaluate its stock. To evaluate a company's stock, you'll need to analyze its financial statements. This includes the income statement, balance sheet, and cash flow statement. By examining these statements, you can determine the company's profitability, liquidity, and financial health. You'll also want to look at other factors, such as industry trends, competition, and management quality, to get a more complete picture of the company's potential for growth. The differences between common and preferred stocks. There are two main types of stocks, common and preferred. Common stocks represent ownership in a company and offer the potential for long-term growth and dividends. Preferred stocks, on the other hand, offer a fixed dividend payment and priority over common shareholders in the event of bankruptcy or liquidation. However, preferred stocks generally offer less potential for long-term growth. The pros and cons of investing in equity markets. Investing in equity markets can offer the potential for high returns over the long term. However, there are also risks associated with investing in stocks, including market volatility and the potential for losses. It's important to carefully consider your investment goals and risk tolerance before investing in equity markets. The impact of market trends and economic indicators on equity markets. Equity markets are influenced by a variety of factors, including market trends and economic indicators. For example, rising interest rates or inflation can negatively impact equity markets, while a strong economy and low unemployment can have a positive effect. It's important to stay up to date on these factors and their potential impact on equity markets. The role of dividends in equity investing. Dividends are payments made to shareholders by a company out of its profits. They can provide a steady stream of income for investors and can also indicate the company's financial health. However, not all companies pay dividends, and those that do may reduce or eliminate them if financial conditions change. The risks associated with equity investing and how to manage them. Investing in equity markets involves risks, including market volatility, company-specific risks, and macroeconomic risks. To manage these risks, it's important to diversify your investments across different stocks, sectors, and asset classes. You'll also want to consider your investment goals and time horizon, as well as your risk tolerance. The importance of diversification in equity investing. Diversification is the practice of spreading your investments across different stocks, sectors, and asset classes to reduce risk. By diversifying your portfolio, you can minimize the impact of any single stock or sector on your overall investment returns. This can help you achieve a more balanced and consistent return over the long term. Strategies for long-term equity investing. Investing in equity markets requires a long-term perspective. To achieve long-term growth and stability, it's important to develop a disciplined investment strategy that's based on your goals, risk tolerance, and time horizon. This may involve investing in a mix of stocks, bonds, and other assets, and rebalancing your portfolio regularly to maintain your target asset allocation. So there you have it, a beginner's guide to understanding equity markets. We've covered a lot of ground in this video, from what equity markets are to how you can invest in them. By taking the time to learn about equity markets and develop a solid investment strategy, you can achieve your financial goals and build long-term wealth. Thanks for watching, and happy investing!